Welcome, everyone. Welcome to La Trobe University, Bandura campus. We're delighted to have Dr. Don Brash, the former governor of the Reserve Bank of New Zealand, and currently, very recently turned a politician again. I would also like to welcome my students from third-year subject Central Banks and Monetary Policy. And I'm sure we're all looking forward to hearing what Don has to say. We are not going to be talking too much about politics. We'll try to talk mostly about economics. So welcome, Don. Thanks for coming.
Thank you very much.
Now, my first question obviously is going to be aimed at the Reserve Bank Act of 1989 in New Zealand, which was quite a new development, quite a revolutionary change. Can you please outline what this change was about?
Yes, I think the background was that New Zealand had a very bad inflation record over the previous 20 years, quite high inflation by developed country standards, into double digits for quite a period of time, above 10%. And not only was it fairly high, but the cycles in inflation bore a curious resemblance to the political cycle. And we had, as indeed most countries had at that time, a central bank which was totally under the control of the government. The central bank provided advice on monetary policy to the government, but the decisions were made by the Minister of Finance typically. And that, as I say, meant that monetary policy was very much driven by the political needs of the government rather than by the need to keep inflation under control. And we'd had a period under a government, the Prime Minister of which was a guy called Rob Muldoon, where the inflation rate was particularly bad. When the Labour government came to office in '84, under Prime Minister David Lange, Minister of Finance Roger Douglas told the Treasury and the Reserve Bank in New Zealand, find a way of Muldoon-proofing monetary policy. Try to find a way by which politicians could not manipulate monetary policy for their short-term political gain.
So is this what's sometimes called institutionalizing good policy?
That's exactly right. And we had, I was not myself then involved in the central bank, but Reserve Bank sent several people around the world talking to a number of central bankers and academics to say, look, what's the best way of dealing with that? Now, bear in mind that prior to that period, there were really two models of central banking in the world. There was what I call the old Bank of England model, where, as in New Zealand, we had the government making the decisions, the central bank simply implementing those decisions. And we had the other model of total central bank independence. The Bundesbank in Germany, the Swiss National Bank in Switzerland, Federal Reserve Board in the United States, were a very small number of central banks where the central bank was, at least in principle, totally separate from the political process. The Reserve Bank of New Zealand Act in 1989, which you referred to, was an attempt to find a third approach to central banking. And I think it's been very successful. It basically said, look, let's recognize that monetary policy does have an impact on inflation. It does not have an impact on economic growth or employment in the long term. It does in the short term, clearly, but in the long term, the best thing that monetary policy can do for growth and employment is to keep inflation low and stable. So the law says that monetary policy must be focused on achieving and maintaining stability in the general level of prices. There's no reference to employment, no reference to growth, no reference to balance of payments, no reference to motherhood. It's just straight price stability.
So how is this designed to actually keep inflation under control? I mean, what's the institutional improvement here?
Well, the law says that's what monetary policy must do. And of course, as in Australia, as in many other countries, monetary policy has to achieve a whole series of objectives reflecting the fact that academic opinion years ago thought that monetary policy actually could deliver high rates of employment or faster rates of growth or whatever. But the more modern thinking, of course, is that monetary policy basically affects the inflation rate. So we focused on keeping prices stable. The second unusual feature of the framework was that it required the government of the day, the Minister of Finance on behalf of the government, to reach a formal written agreement with the governor defining what stability in the general level of prices will be during the governor's term of office. And of course, originally that was 0 to 2% measured by the CPI. We'll come back to that in a moment. But a formal agreement between governor and Minister of Finance. So there's a political input into the decision about the goal. But then, thirdly, the governor has complete operational independence to deliver the agreed target. Complete independence. But with the independence, of course, in the New Zealand framework goes accountability. And I well recall talking with the minister before the bill was finalised. I expressed surprise that the contract was to be between the minister and the governor, not between the minister and the central bank. And he said, yes, we can't fire the whole central bank. We can't even fire the central bank board, but we sure as hell can fire you. And it was designed to make it clear that, yes, the governor had independence to run monetary policy, but the quid pro quo was that the governor was to be held accountable for delivering the target. The last feature I mentioned is, and in some ways it's the most important single part of the framework, mandatory transparency. The form of the agreement between the minister and the governor is transparent and public. Any change in that contract has to be public. The central bank has to disclose on a quarterly basis how it sees the economy, how it sees the inflation outlook. And right through the whole process, it is very transparent. And that, in a sense, is what locks both parties into prudent policy. You can't easily depart from that, but everyone knows what the game plan is. So it's worked very well.
It's interesting. I mean, you touched on the very topical issues of interactions between monetary and fiscal policy. What you're suggesting here is that a stronger commitment to monetary policy can, in fact, have an effect on both monetary and fiscal behavior. And I remember a long time ago when we talked, and I told you that this was one of the result of a paper of ours, that monetary policy can, under some circumstances, discipline fiscal policy. And you said, well, this is exactly what happened in New Zealand. So can you elaborate on that? How did that happen in New Zealand?
Well, that's exactly right. I mean, the first agreement between me and the Minister of Finance was signed at the beginning of 1990, and I was required to deliver an inflation rate between 0 and 2% by 1992. It was higher than that by quite a margin at that point. And 1990 was the year in which there was the general election coming up towards the end of the year. The government eased fiscal policy in mid-year, had a budget around June, eased fiscal policy, widely perceived as quite an aggressive easing of fiscal policy. And the question was, well, what does the central bank do in the face of a major easing of fiscal policy and an inflation target which the government and the Reserve Bank have agreed? So, of course, we had no choice than to tighten monetary policy. And that had a very substantial impact on thinking about the interaction between monetary policy and fiscal policy in New Zealand. The opposition party, the then National Party, campaigned that if they won election, they would get interest rates down, not by leaning on the central bank, but by tightening fiscal policy and liberalising the labour market. They said, if we tighten fiscal policy, liberalise the labour market, we can get the central bank effectively will be able to ease monetary policy and still reach the agreed target. So no question that it had a major impact on fiscal policy. Going on 5 or 6 years, when by this time the national government was in office and running a big surplus, they said we want to reduce tax rates. But we'll only do that if A, the budget is still in surplus, B, the government's debt target is still being met, but C, if the central bank confirms that they can accommodate that reduction in tax rates and easing of fiscal policy, if you like, without the need to markedly tighten monetary policy. And they formally wrote to me saying, do you think if we cut income tax rates like this, you can still keep your inflation in target without an aggressive tightening of monetary policy? And we said yes. So there's no question at all that a tightly specified and agreed inflation target between central bank and government does have an impact on fiscal policy.
Well, we've done some more research on this. I think I've prepared 4 slides here in this respect. What you're going to see is the fiscal balance in inflation targeting countries. So this is the mean. So this is just to better show the trends. These are the 5 early adopters of inflation targeting: Australia, Canada, New Zealand, Sweden, and UK. And what you see, always the shaded area indicates the introduction of inflation targeting. So what you see that after the introduction, fiscal policy has been kind of still excessively expansionary. So fiscal policy have been running deficit. But in all 5 countries, after this transition period of about 1 or 2 years after the introduction, fiscal policy has actually improved. And all those countries have started running surpluses and get their fiscal house in order. Now, if you contrast it, the next slide is going to show us the non-targeters, the 3 main non-targeters, Japan, Switzerland, and the US. And what you see is that over the same period of time, there's actually no improvement in fiscal policy at all. In fact, you see very much the opposite. Now, this is a very crude measure. We've done some more research. So the next slide is just going to give you an example of an inflation targeter using structural VAR models. I'm not going to go into the details, but what you basically see here, you see the green impulse response is for the period of 1980 to 1993. So this is pre-introduction of inflation targeting, and it shows you the response of a government expenditure shock, or the response of monetary policy. So what you see is that whenever the government started spending more, monetary policy has actually reduced interest rate and accommodated the government's running the debt. And this is in stark contrast with what happened after the introduction of inflation targeting, which is the blue line, where if the government engaged in excessive spending, central bank actually went out and increased the rate, so kind of offset the effect on the economy. And again, the next slide is showing, is giving Switzerland as an example of a non-targeter, and you see very much the opposite again. Prior to inflation targeting, and you mentioned that they had a lot of independence, and they were a traditionally conservative central bank. So we see the offsetting, the fighting the government before in the 90s, 80s, and early 90s. But after that, we actually see the very opposite. We see monetary policy accommodating fiscal shocks. Mm-hmm. Now we're re-estimating this using kind of more fancy methods, but this just gives you an idea that maybe what you're talking about, what your experience in New Zealand is, it might be generalized into a more general type of framework. But now you mentioned managing expectations. You mentioned the benefits of transparency. So if I can ask you about this, how does that work? There's this anchoring expectation that people talk about. What is it?
Well, I think it does. When we first introduced this 0 to 2% target in New Zealand, a number of people thought we were absolutely out of our mind. We'd had this quite high inflation for quite a long time. Most people thought we might, with a bit of hard work, get it down to about 5. But the idea of getting it below 2 was regarded, even within the central bank itself, as somewhat preposterous. I well recall the head of our trade union movement in New Zealand writing an article in the newspaper saying, look, this single-minded focus on getting inflation under control is nuts. It's very bad news for workers, it's very bad news for employment and so on. But unfortunately, this madman in the central bank is absolutely committed to doing it, so we really have no choice than to adjust wage and salary demands in line with that objective. And in fact, I recall having a meeting with him and the then Prime Minister in which I said, look, unemployment is going to go up if you guys keep on insisting on wage demands, which are markedly higher than the inflation target which the government and we have agreed. Because prices are going to be going up at this modest rate. If your wages are going up at 2 or 3 times that rate, the thing which gives is the employment rate. And he absolutely understood that point, and for a period of, I don't know how many months, but a number of months, he went around the countryside campaigning. It's the head of the union movement, campaigning for modest wage demands. Because he said, otherwise, unemployment's going to go up. And I think that was very important. I must say I'm not well typecast for this role, Jan, because I'm a nice, gentle, kindly guy. You need to be seen as a hard-nosed, miserable so-and-so, because what you've got to convince people of is that you're absolutely committed to the inflation target. Because once they believe that and start behaving in line with that, then the social costs of getting there disappear. I mean, the social costs of getting inflation down relate to the fact that people don't really believe you mean it. So they behave in ways which are conditioned by the past, high inflation, and not by the new inflation target. I once recall having a discussion with Michael Cullen, who became the Labour Party finance spokesman, and we're talking about employment and inflation. And I said, look, when you reduce inflation from, say, 10% to 2%, unemployment almost always goes up. Why? Because when inflation is 10%, wage and salary earners demand wage increases to that, gear to that expectation. Firms price things on that expectation. The general assumption that's what's going to continue. Now, if monetary policy squeezes down the inflation rate to 2% per annum, all of a sudden businesses find they can't pass on 10% wage increases, lay off staff, some businesses collapse, unemployment goes up. And it stays up until price setting behaviour and wage and salary setting behaviour adjusts to whatever the new inflation rate is. And then unemployment returns to whatever drives the long-term rate. Conversely, of course, if inflation's been trucking along at 2 and you wind the inflation rate up to say 6 or 8, in the short term, unemployment goes down. Why? Because real wages have gone down. Real wages have gone down. But when workers realize they've been taken for a ride, and start demanding higher wages to compensate prices, then unemployment again returns to where it was previously. And Michael Cullen said, I guess you get a bigger increase in unemployment when you're winding inflation down than you get reduction in unemployment when you're cranking inflation up. Because given our history, it's so much harder to reduce inflation expectations than to increase inflation expectations. He was absolutely right.
Well, there's a lot of evidence to suggest that wages are more rigid downwards than upwards. But now you raised the issue of credibility, which largely determines the cost of disinflation. And I recall this quote by Mervyn King at the Bank of England, and he had this nice analogy, basically saying, well, if the central bank had perfect credibility, then basically they wouldn't have to change the interest rate at all. They'd be like the referee in a game, and they just the fact that it's there, just the announcements of, okay, if you guys don't adjust your behavior, we're going to do something with the rates, would be enough for the economy to adjust the way that is needed. Now, obviously, that's the ideal situation. But have we moved from, if you compare the situation in the 1980s and the credibility of the Reserve Bank of New Zealand to what it has had, 20 or 30 years later, do you think that the gains in credibility have been in this direction?
Absolutely, I agree with Mervyn King. Funny enough, that's true not only of the economy more generally; it's also true of financial markets. One of the things which astounded me in the first decade or so of my being governor, we did not have an official cash rate as the RBA does now and as the Reserve Bank does now. We modified the total amount of settlement cash across all the settlement banks and their accounts with the Reserve Bank. And we basically ran the system on a very, very tiny base of settlement cash. And the principle was that if we wanted to ease, we would increase that slightly. If we wanted to tighten, we would reduce it slightly. But in fact, over a period of years, we didn't change it at all. Why not? Because all we had to do was say, we're a bit unhappy about the inflation rate. All of a sudden, things would tighten. It was the ultimate kind of no-hands central banking. Occasionally, of course, you had to do something because you had to make the financial markets know that you were actually serious and that you were able to tighten or loosen conditions. But for the most part, we barely touched the levers at all. All we had to do was publish a forecast for the inflation rate and say we were happy or unhappy. So it worked very well.
Now, I mean, given these benefits, and there's a lot of research showing that inflation targeting does seem to anchor expectations at the target level. Why do you think that some countries like the United States or Switzerland have not really adopted a numerical inflation target? Now, especially if you take into account the fact that the Fed chairman, Ben Bernanke, was a big proponent of the regime before he became the chairman of the Fed, and so everyone expected that he might go ahead. Can you see any reasons why?
Well, you're right. It is surprising. I think most developed countries now have a formal inflation target. The United States is the major exception to that, and Bernanke wrote a book literally on inflation targeting. I can only assume that it has to do with two factors. I don't know the answer, but I suspect the answer may be that in the legislation under which the Fed operates, the Fed is obliged to focus not just on inflation but also on employment. Now, Bernanke, like Greenspan before him, may be absolutely convinced that the only thing monetary policy can do for employment is to keep prices, the price level low, and price increases low and stable. But if the legislation is such that he's, in theory, also responsible for unemployment, then he may feel unable to adopt a framework which is so explicitly focused on inflation. I mean, I can't think of any other good reason. It may also be that there are some people who don't understand inflation targeting, who simply don't understand that it isn't the rigid straitjacket that some people try to portray it. I mean, Joseph Stiglitz, for example, has said, pity all the countries with inflation targets because it's such a rigid straitjacket that crucifies people. Well, I mean, every inflation targeting central bank that I'm aware of does specifically allow for exogenous shocks. If you get a doubling of the international oil price for the sake of argument, you're not required as a central bank governor, and any central bank I know, to so tighten monetary policy that every other price falls to compensate or offset the rise in the oil price. So if there's a genuinely exogenous shock, oil prices or change in the GST rate or something of that kind, most inflation targeting central banks look through that. But that may not be fully understood by some of the critics.
Well, in fact, if you look at the statements of the former Fed chairman Greenspan, this would be his concern about the straitjacket, about focusing too hard on inflation and letting ignoring the real economy. And again, there's a lot of evidence showing that the variability of unemployment and output in inflation targeting country has not increased compared to non-targeting. In fact, if anything, it was reduced.
Yeah. I'm not sure whether Greenspan really believed that, I have to say, because Greenspan understood as well as anyone that monetary policy does not have a long-term effect on employment. I've spoken to audiences in Jackson Hole, Wyoming, which is the central bankers' junket at the end of August from time to time, and talked to Greenspan about the fact that we have only a single focus for monetary policy, and he was green with envy. He said, I wish we had that in the United States.
Now, obviously, it's important to look at the recent episode and try to consider what the lessons from the global financial crisis are in terms of monetary policy. So one of the issues that is often suggested is that central banks maybe should look at a broader measure of inflation than just consumer prices, maybe also including asset prices, or maybe even reviving some monetary measures. What's your view on this?
You mentioned Mervyn King earlier, the governor of the Bank of England. I asked him that question myself a couple of years ago. I said, do you still believe in inflation targeting? He said, yes, I do. I think inflation targeting is a good system, but it's not sufficient. It's necessary, but not sufficient. And he was, at that point at least, ready to say we do have to keep an eye on some of the other prices in the community, such as asset prices. And he quoted some numbers, actually in a speech he gave beginning of last year, that over the 5 years to 2007, when CPI inflation in the UK had averaged close to 2%, which was his target, the balance sheets of UK banks had trebled in size over a 5-year period. And what he was saying was that clearly was a major factor feeding huge increases in particularly property prices in the UK. And as a consequence, of course, when that bubble burst, all hell broke out. So he was, I think, inclined to say, yep, inflation targeting is good, but we probably do need to think of some kind of macroprudential instrument which will restrain the growth of money and credit to avoid those kind of asset price bubbles. Can I just say one other comment? There's a very interesting article in the annual report of the Federal Reserve Bank of Cleveland. The Federal Reserve Bank of Cleveland at that time in the late 1990s, the president of it was a guy called Jerry Jordan, and it's widely assumed that he wrote the article. And he was a member of the Federal Reserve Board's Federal Open Market Committee at the time. Didn't feel able to write about the 1990s, so pretended he was writing about the 1920s, but the relevance to the 1990s was very obvious. In the 1920s, we had high productivity growth, very well controlled inflation, CPI inflation, massive increase in credit and money and asset prices. And of course, it all came horribly unstuck in 1929. And he was really saying to Greenspan and anyone who else would listen, this is the 1990s again. I mean, this 1990s is 1920s again. High productivity growth, well-controlled CPI inflation, very sharp increase in money and credit, big asset price bubble in the particularly high-tech stocks, and this is going to end in tears. And of course, that's exactly what happened.
Well, it's even more the case in the mid 2000s.
Absolutely.
And there seems to have been an additional factor, which is you know a lot of the cheap exports from Asian countries have artificially kept CPI low,
That's right.
which kind of probably kind of distorted the CPI signals that the Fed was used to deal with. So I mean, you mentioned the crisis. Obviously, to deal with the crisis, the Fed, as well as the fiscal policy side, have engaged in quite unprecedented measures. I mean, we've seen all this quantitative easing. What's your view on this, or can you maybe explain briefly what it's about and whether you think it's going to be effective? What happens if you hit the zero lower bound on interest rates? What do you do as a central banker?
Can I go back to the earlier part of the decade? Because you mentioned the very low American interest rates through the last decade. I think we'll come to recognize in due course that China's decision to anchor its currency to the US dollar at an artificially low level is a major source of the current difficulties. What happened, as you say, was that China exported vast amounts of goods to the United States, keeping inflation pressures low in the United States, justifying the Fed keeping its policy instrument low. Inflation was low, why should we tighten? It's kind of argument. China, of course, accumulated vast foreign exchange reserves, invested them in US treasuries, thereby keeping longer-term rates low also. And that was fantastic for the United States. Low inflation, low interest rates, rising house prices, rising property prices. Everybody was happy. It was good for China, too, in the short term, because China had access to the world's largest consumer market, could employ lots of people coming in from the countryside. But it was a kind of a Faustian bargain, because while it was very nice in the short term, it backfired badly in the longer term, and both sides are now angry. I mean, we've seen the implosion of the property bubble in the United States. Americans no longer feel grateful for Chinese imports, they feel angry about them. China feels angry because the foreign exchange reserves invested in US treasuries are going down in value. So both sides feel angry with the outcome. And I think when we look back on the global financial crisis, we will say that that was one major factor driving it. There are many others as well, but I think it's too easy to blame the financial crisis on greedy bankers. There were greedy bankers without doubt, but it was only one of the factors which caused the crisis.
Now, I think this hypothesis, Bernanke called it the global saving glut. There was a lot of savings from China as well as Middle East and Japan that pushed the real rate really low. But now I want to talk about the future a little bit because obviously the future facing a lot of advanced countries, it doesn't seem very optimistic, taking into account the demographic factors. aging populations. I actually, to motivate this, I have a series of slides here, which some of you might find staggering. What happens is that most countries, so you're going to see the old age dependency ratio in a number of countries, and there are 3 bars. The blue one is 1960, the red one is 2005, and the green one is 2050, so that's the prediction. And old age dependency ratio is actually defined as the number of people 65 plus over the number of people between 15 and 64. And what you see is that traditionally in 1960s the old age dependency ratio was relatively low, say between 5 and 15%. It's increased quite a lot since then, so now it's usually about around 20%. But what you see, the green column, that in the next 3 or 4 decades, a number of countries are seeing huge increases in this old age dependency ratio. In other words, there'll be a lot of old people. Now let's go to the next slide, because it's interesting to see the implications. This is for US data, and so these are the 2 main form of expenditures. We've got Social Security, so roughly speaking pensions, and you see that this expenditure really picks up when people turn 60 and so on. So most of this expenditure goes to the elderly, but probably even more importantly, when we look at Medicare expenditures, again, most of the expenditures go to the people over 60. So these are the expenditures. Contrast this to the next slide, which shows you the taxes, the tax profiles. So the next slide, if we can have it, the tax profiles over the life cycle. And again, what you see is that people pay taxes roughly between 20 and 65. So if you have these huge increases in the old age dependency ratio, combined with these profiles, it means that there's a big hole in the budget 20, 30 years into the future. What do you think about that, and how should we deal with it? And
well, it's a serious issue, not least because most developed countries start this process in a very weak fiscal position, with government debt levels at very, very high levels. The worst case, I guess, is Japan, where the government debt to GDP ratio is now over 200%, at least on a gross basis. But the United States, UK, in fact, all the G7 countries have government debt to GDP ratios which are approaching 100%. That's before the baby boomers really start to reach 65. So it's a serious position, I think, and I think you're absolutely right to highlight it. One of the worrying things also is that the savings glut, which you talked about coming out of Asia, will also disappear, because China's demography also is not going to be unlike that one there. China's policy of 1 child per family means that China will quite quickly face an aging problem, quote unquote, very much like developed countries. So that the world as a whole is going to face a situation where a relatively larger and larger share of the total population will be over 65. That has implications for pensions and has implications for health spending, because as you rightly show, most money spent on people's health takes place in the last few years of their life. So we're going to get a big increase in those costs as more and more people go into those older age range. Now, the question is, what do you do about it? For the individual, it makes sense to save more. What is not clear, though, is how the world as a whole deals with that, because at the end of the day, you save more on the assumption you can draw down on someone else's resources to supplement your own in retirement. But if all developed countries, and China and Japan and Korea, are in the same situation, it's not clear how you can't draw down from those countries, you can't draw down on Mars, you have to draw down on something else. And my hunch is the only real solution will be people working longer, retiring later, and staying in the workforce and contributing to output, also contributing to tax revenues, longer than has been the case in the past. Now, politically that's quite tough. I see that in France the Socialist Party is recommending reducing the age of eligibility for their pension from 62 to 60. I don't know whether they can't count, but it's depressing that political parties can make proposals of that kind and be taken seriously.
So, I mean, given the political realities, and I think the US is a similar situation where tax increases are not really something that we can expect in the near future, do you think that it's all going to end up badly? I mean, are these countries going to default? Or obviously the other solution that's been floated around in the literature is that monetary policy picks up the slack, and to some extent the debt will be inflated away, or the promises that have been made to pensioners will be inflated away. And do you think it's a reason for concern?
It certainly is a reason for concern. I agree with that. Governments in democratic countries find it very difficult indeed to confront voters with reality. And I guess that's never clearer than right now in the United States. I mean, you allude to that, and we were talking yesterday about the fiscal outlook for the United States. You don't have to look very far ahead to realize the US is in serious fiscal trouble. I read an article by a professor of economics at Boston last year, which argued that to stabilize the American fiscal position in the long term, given their promises on Social Security, given their promises on healthcare, the federal tax take has to roughly double from 15% of GDP to nearly 30% of GDP. Now, you've got American congressional situation, which makes that very, very hard to achieve. Well, if you say fiscal policy can't fix it, are we faced with the possibility that central banks will indeed simply allow inflation to erode the level of the debt? Well, I profoundly hope that's not the case, and so far at least, central banks around the world appear to be quite firmly committed to keeping inflation under control. But there's clearly a collision coming between those commitments and the country's willingness to fund them.
I believe Larry Kotlikov was the Boston economist you mentioned. He's been very instrumental in kind of arguing that we really need to look at budgets in a kind of intergenerational type of perspective.
Absolutely right.
You know,
yep.
Looking at a budget in any 1 year is kind of meaningless from a long-term perspective. There's actually, in line with that, there's a recent study just a month old by the IMF that finds, you know, this is the most recent estimate of the fiscal gap in the United States, and the conclusion is that a full elimination of the fiscal and generational imbalances would require all taxes in the US to go up and all transfers to be cut immediately and permanently by 35%. A delay in the adjustment makes it more costly. Now, again, that's probably the reality is not going to see that kind of adjustment.
It's a worry. It's a worry.
Now, maybe it's the time for me to give an opportunity to the students to ask Don questions. So feel free to fire away. Charlie?
As a central banker, what do you find in the long run more dangerous? Government restructuring of the debt, or government default, or hyperinflation?
Which is more dangerous, government default or hyperinflation?
Yeah. For example, in Europe, you have the choice of either letting Greece default, or they can just literally inflate the debt away. Obviously,
because Greece can't inflate it away because it's part of the European.
Assuming all the other countries agree with it, but
okay. I think there really are three options, aren't there? One is that Greece leave the European Monetary Union, and then they can presumably inflate some of the debt away, or let the drachma decline in value, or some other way reduce the burden of the debt. Alternatively, they stay with the European Monetary Union and renegotiate their debt. I mean, it's hard to see how else they can do that. I suspect that it's less disruptive to renegotiate the debt than to leave the euro, but it's a tough choice.
In 2008, you gave a speech entitled Big Ideas to Supersize the New Zealand Economy. One of the suggestions you gave was to give the Reserve Bank of New Zealand an additional instrument to modify inflationary pressures, namely a constrained authority to vary the excise tax on fuel. You said that would provide stability of the exchange rate for exporters not provided by the official cash rate. So I have 3 prongs to this question. Firstly, was that ever implemented? Secondly, do you still believe that it's viable for New Zealand and all the rest of the world? And thirdly, how would a central bank balance the 2 such tools, being the excise tax variability and the official cash rate, based on the classic economic monetary policy trilemma?
This guy's obviously done a lot of research. You're quite right. That speech is on my website. The proposal was motivated by a concern which the export sector has in New Zealand, and I suspect the export sector has in Australia, that floating currencies fluctuate. And the amplitude of those fluctuations is quite substantial. If you look at the New Zealand dollar, Australia's not quite as bad, but it's not very different. If you look at the New Zealand dollar over the last 20 years, the appreciation from the trough to the peak, the largest appreciation over that 20-year period, on a trade-weighted basis, real terms, was about 50%. And you think that's a heck of a large appreciation to deal with if you're an exporter. Now I looked around the world, and that's characteristic of most floating currencies. In New Zealand, we think it's because we're such a tiny country, small currency, floating all over the place. We can't be expected to cope with that. But the trough to peak appreciation of the yen has been greater than 50% over the last 20 years. US dollar about 20%, Canadian dollar about 50%. So big swings in floating currencies are absolutely normal. So I was looking for ways of reducing the amplitude of those fluctuations by finding something other than the official cash rate to move. Now, the official cash rate isn't the only thing which drives drives the exchange rate, as we all know. But it's one of the things which drives the exchange rate. And I thought, well, is there some instrument we could give the central bank to supplement the official cash rate, not to replace it, just to mean you mightn't have to move it quite as aggressively. And it seemed to me, Larry Ball, in fact, suggested varying tax rates generally. And now I think that's totally impractical. I mean, you simply can't kick income tax rates or the GST rate around in practical terms as much as you'd like to with monetary policy. But the excise tax on fuel, you collect from only a very small number of points. The public are accustomed to the price of fuel going up and down like a yo-yo. And because demand for it is inelastic, at least in the short term, the effect on other spending is very similar to the effect of changing interest rates. So I thought it was a useful way of supplementing, not replacing, supplementing the interest rate. Just you wouldn't have to use the interest rate quite as aggressively if you also could vary the excise tax on petrol. No, it was never adopted. Most people just ignored it completely. I think that's a pity because I thought it was not a bad idea, but no one's taken it seriously either in New Zealand or anywhere else.
Yeah, we had a discussion about it when you gave the proposal here, and I expressed some concern regarding economic theory and which side of the market, supply demand, would be implemented and so on. But we can leave it for the time being. Can I invite another question? Jury?
You mentioned that your inflation target was between 0 and 2%. Personally, what target do you feel most comfortable with? Because as you're heading close to 0%, you play with the possibility of deflation and a liquidity trap. So do you think that it's better to target the higher end of the inflation intervals?
0 to 2 was rationalized by my central bank colleagues as being 1% plus or minus 1. And 1% was chosen because it's the estimate, which is done, I think, in the United States, that a 1% measured increase in the CPI is probably equivalent to genuine price stability. There was a bias in the measurement of the index, not allowing properly for quality changes and so on. So we said 1% genuine price stability plus or minus 1 to allow for variability. That was how we rationalized it. The origin of the number actually is much cruder politically. Inflation, which had been very high in New Zealand, came below 10%. And the then Minister of Finance, Roger Douglas, was asked on television, "Aren't you satisfied now? Inflation rate's only 9." And Roger Douglas apparently said, no, I want price stability, like 0 to 2. And that sort of stuck, even though at the point that he announced that he had done no analysis of the logical correct target at all. Subsequently, we changed it from 0 to 2 to 0 to 3. And the logic for that was that, particularly in a very small country, you get a lot of shocks which have an impact on the CPI, which tend to get smoothed out in a much larger economy. So we said, look, rather than constantly explaining why you're outside this 2 percentage point range, widen the range a bit so that you're not so constantly explaining. Then in 1999, I think it was, the target was changed again to 1 to 3, and that's where it is now, 1 to 3. For the reason I suspect that you mentioned, that when you're getting close to 0, most central banks are going to be keen to avoid getting too close to 0 and be trying to shy away from that. So we said, look, let's recognize reality and choose a target a bit higher than 0. I have to say I'm not totally persuaded by that myself, because yes, the 0 bound is an issue for a large economy. For a small economy like New Zealand, and indeed like Australia from this point of view, the other thing which can affect monetary conditions is an easing in the exchange rate. And that can have quite a profound impact on monetary conditions. So if you drop the Australian interest rate to 0, say, you'd almost certainly get some reduction in the Aussie dollar. And that would provide some measure of stimulus, which may not be so obviously true in the case of the United States.
This is interesting. If I can add, this question, I suppose, was motivated by the fact that the students had the opportunity, an opportunity to play the simulation game. I'm not sure if we've ever played it together, but you act as it was designed by a Swiss economist, Ivan Langwiller, and it's very neat. You get the opportunity to act as a Reserve Bank governor. You're changing the interest rate, and you see all the data, and you're reacting. And the observations that the inflation target in that game is set at 1.5 percentage points. And the observation that they made was if they were targeting a higher level, say 2.5. Meaning they stay clear of deflation, they are able to achieve a much more stable inflation rate. Whereas with the lower levels of the inflation target, they kind of tend to be more aggressive when inflation is below the target, which obviously leads to bigger swings. So it's interesting to see that you, in the real world, you haven't really kind of had this problem of kind of being too panicky when you get closer to deflation.
No.
Maybe in an open economy you have an extra channel.
I think that's a crucial point, and the bigger the tradable sector is, the more relevant the exchange rate becomes. Incidentally, one of the things you haven't talked about is the fact that we used the Monetary Conditions Index at one point for 2 years, in fact, in the 90s. We didn't work it properly and we abandoned it. But in a small economy like New Zealand, like Australia, like Canada, and we adopted it from Canada, in fact, the exchange rate has a very profound effect on inflation, both directly through price effects and indirectly through shifting production and shifting spending and so on. Therefore, the question is, how do you calibrate interest rate movements for what's happening to the exchange rate? And at that point, we didn't have an interest rate instrument per se at all. We just had a view of what the inflation target should be. But we knew that both interest rates and the exchange rate had an effect on the inflation rate. So we decided to determine a formula trying to work out how much a 1% movement in the official cash rate or interest rates, we use 90-day bank bill rate, how much effect that would have on inflation rate as compared with a movement in the exchange rate. And we determined a ratio of those two, and then ran monetary policy by saying we wanted the monetary conditions index between X and Y over the next quarter. And we didn't try to determine whether that was an interest rate movement or an exchange rate movement, but we told the market what the conversion rate between interest rates and the exchange rate was. So if the exchange rate fell very sharply, other things being equal, we would expect interest rates to rise in order to deliver the monetary conditions we wanted. Now, it didn't succeed in New Zealand, mainly because we just didn't get our head around how big those movements in the MCI needed to be. We didn't move the MCI nearly aggressively enough through the Asian crisis of 97, 98.
Are you talking the weight on interest rates or on the exchange rate?
Well, it wasn't so much the relativity of the two as the index number. Right, we defined the index as being 1,000, being the monetary conditions in the December quarter of 96. And each quarterly monetary policy statement, we said, this is the range within which we want the index to be over the next quarter. And we were easing policy, reflecting the Asian crisis and the impact of that on the New Zealand inflation rate, but we weren't dropping it nearly far enough. If we had a longer history of the MCI, we'd have seen we had to drop it by much more. And as a consequence, we had conditions too tight.
Okay. Any other questions? Is there any other? Okay, next. Thanks.
Should finance ministers and treasurers be made to have a compulsory background in economics?
Did everyone hear the question? Yeah. Not sure of the answer to that question. I mean, if you have a good treasury and a minister who's intelligent and can understand the arguments, I don't think they have to be economics graduates. Michael Cullen was the Minister of Finance under the Labour government between 1999 and 2008. And I can't be totally objective about Michael Cullen given my political environment, but to be fair to him, he was actually very bright. He ran a fiscal policy which actually was quite responsible through the first half of his 9-year period. He went mad in the last few years because the current Minister of Finance, Bill English, blames me for the fact that Michael Cullen was irresponsible in the last period because when I was leader of the National Party, we came within a hair's breadth of winning the election in 2005. And it was really about that time that Labor decided shelling it out in a very irresponsible way. Government spending went up by 43% in 4 years between 2005 and 2009. And Cullen lost it at that point. But it wasn't because he lacked economics. It was because he was under huge political pressure from his own colleagues to spend up big. He was an historian by background. So I don't think you have to be an economist, but it just helps you've got enough intellectual horsepower to understand the arguments which Treasury is putting to you.
Well, hopefully they shouldn't be lawyers. But that's my personal bias. Any other? Yes, Steve?
You guys touched on macro potential regulation to address potential asset price bubbles. Do you have any ideas on what sort of tools could be used or formulated to do this?
I've got a feeling that particularly with those banks which are perceived as too big to fail, it may be necessary to vary the capital ratio and or the liquidity ratio that those banks have to maintain in addition to simply changing an official cash rate. There may be other ways of doing it, but I suspect that if you were to increase the required capital ratio and or the required liquidity ratio, you would have a material effect on the ability of those banks to increase their lending. So I suspect that's where I would be.
Okay, well, I think we are running out of time, so we might have to finish here. But I would like to ask everyone to join me in thanking Don for his very interesting views. Yeah, hopefully we'll get to chat soon another time.
Very good. Thank you.
Thank you, Don.
Thank you very much.
Thank you.